one or two L.
All right, we are all set.
Ready?
Yeah, I am going on mute.
Okay, cool. All right. Welcome to the Beta Mu Alumni Financial Literacy Panel. The purpose of this is to provide education and knowledge about money management, savings, your children's college, retirement for yourselves, home ownership, and stock investment. We know 2020 has been a very interesting year. We are still in the midst of a pandemic, right along with nationwide protests. And what we want to do today is just kind of discuss kind of wealth building. All right. We hope this is informative and helpful. I have 4 experts here to help us get through the discussion. If you have questions, kind of post them in the chat, and we will try to pose them to our guests. We're going to host this panel for about 45 minutes, then give you all about 15 minutes to ask any burning questions you may have to our panelists. If you have more questions, you can reach out to each panelist via their Facebook. I'm gonna go ahead and start with Jonathan Harris. Go ahead and introduce yourself, Jonathan. And I don't know how to unmute. Dre, if you know how to unmute, go ahead.
All right. Yeah, my name is Jonathan Harris. Currently, I'm residing in Chicago, the suburb of Chicago, Illinois. I'm currently the CFO for Honeywell LST, which is Life Cycle Solutions Technology, where it's a $1.6 billion oil and gas business. Responsible for refining petrochemicals and oil and gas. I'm also responsible for budgeting of our total and 3-year annual budget every year. Went to Kentucky State University, across Beta Mu follow too. And I'm excited to be here. I think this is a great opportunity for us to learn and educate each other, to ask this basic questions, just to get started and get the minds thinking about, what we can do with our resources and how we can make it grow.
Thank you, Jonathan. Jonathan is going to be our online investment specialist today. Next, we'll go with Jay Williams. Jay, go ahead and introduce yourself, sir.
Yes, sir. So my name is Jay Williams. I'm a business banking relationship manager with KeyBank out here in Dayton, Ohio. I've been in banking for roughly 11 years. I spent most of my time in retail banking. So primarily dealt with individuals and small businesses. One of my focuses in the retail branch was helping individuals build their credit, knowing what it looks like to establish credit, to be a first-time home buyer, to start a business, what it looks like to generate capital, how to increase cash flow, and working through those processes. But most recently, I did assume a new position as the business banking relationship manager, where I typically deal with clients up to $25 million in revenue and help them in different ways to purchase equipment for their business, to increase cash flow, to primarily just help them run their business more effectively and more efficiently. So today, I hope to add a little bit of value in a sense of if an individual has questions with starting a business, with growing their business, or to simply help individually to build their credit, or to one day be a first-time home buyer. So thank you for joining. Thank you for allowing me to join.
Thank you, Jay. Next, we'll go with Rodney Hardin, who is a financial analyst, and he can give us a little bit more background information on what he does.
All right, thanks, Wes, and good evening, everybody. Rodney Hardin, graduate of Kentucky State University, pledged Alpha Phi Alpha at Beta Mu, spring '93. I'm a financial advisor for Northwestern Mutual. I've spent my career, started my career in banking, It led me through companies like Toyota, Federal Express, Kroger, and I also own my own businesses. I own 3 nightclubs and 1 restaurant here in Cincinnati, as well as being a financial advisor. One of the things that got me interested in being a financial advisor is that when you take a look at Black wealth overall, in 1950, the average Black family had 0 net wealth. And in 2016, the average Black family had just $13,000 in wealth, where the average white family had over $150,000 in wealth. And that disparity continues, but it's how you do some of the planning. And one of the things I'm fortunate to be able to do is work with a lot of families and a lot of individuals, no matter their age, whether they're 21 just getting started or they're 50 years old getting ready to consider retirement. I have the opportunity to work with them in determining how to really set up their overall financial life to be able to retire comfortably and go from there. So that's a little bit about me, and I look forward to this evening and talking to you a little bit.
Thank you, Rodney. Next, we have Eric Speaks. Eric is a realtor that could help us with the buying side of the mortgage or home ownership side. Go ahead and introduce yourself, Eric.
Like you said, my name is Eric Speaks. I'm located here in the Louisville, Kentucky area. I'm a sales manager at Seminole Realtors. Seminole Realtors is pretty much one of the largest brokerages here in the state of Kentucky. We have about 500 agents and typically move about $1 billion in real estate each year. That's primarily in residential real estate, but we do have a small commercial division that we try to tap into. So been doing that for the past 6 years. And just here recently, within the past year and a half, I've been had the opportunity to get into more so of the management and coaching side of things. So at this point in time, we're just trying to focus on creating some initiatives to bridge the gap in, I guess, the wealth gap in the Black community with the rest of America. And it's from our perspective, real estate is one of the major contributors for that gap or the lack of home ownership. So we're just trying to figure out a way to be able to do our part to increase the initiative and opportunity for our community to become homeowners. And I appreciate the opportunity for you all letting me be able to participate in this.
Thank you, Eric. We definitely appreciate you. All right, so let me go ahead. Really, like I said, again, this is to provide education and knowledge to those who do not know. Some of us who do know, and I do not want us to miss out on this opportunity to kind of build capital and financial wealth for our families. Rodney mentioned about us having 0 Black wealth men at 0 in 1950, and now it being at $13K versus $150K for whites. So we really want to kind of do our thing and make finances important and wealth very important to us. So the first question, I'm gonna start with you, Rodney. What advice would you give to a recent grad on savings, and what is a kind of a practical way for them to start saving and building wealth for themselves?
Okay. Great question, Wes. Key thing for anyone is balancing their income that they have coming in and their debt. So as a young college student that you are just getting ready to graduate, there are a couple things that start coming to your mind. You get your first job, the thing you want to do is you want to buy you a nice ride. You want to get you a car. You want to go out and you have this new apartment now. You want to be able to start furnishing your apartment, and you want to start spending and incurring a lot of debt. The thing is to try to pace yourself in terms of that. There is some good debt. Not all debt is bad debt. As you can imagine, a lot of African-American students come out with student loans. They didn't go to school for free. So they have student loans, they are getting an apartment, they're getting a new car, they're starting to try to furnish a lot of those things. But it's really about trying to take your time with that and not just trying to go from 0 to 100 and just trying to have it all right now. The key thing would be to start looking at least saving 20% of your income from the very beginning. And if there are things that I could have done back when I was 21 years old, I'd be in definitely a totally different place. But the advantage that I have now is that I get the opportunity to speak to young individuals. I have a son who's 23. I get to work with him. I have a daughter who's 25. I get to work with her and trying to help get them off to the right start of making sure that you're saving. Getting a life insurance policy when you're 21, you're not too young to have a life insurance policy. And there are different types of policies, ones that can build wealth, like a whole life policy, where you build and accumulate cash inside of that policy. And there are different things that you can start planning and working on, even as a 21-year-old, 22-year-old, or even 30-year-old and up. There are lots of different strategies. The advantages of working with a financial advisor like myself is that we get to help put those plans in place for you and try to make sure that you don't, that you're paying your bills on time, that you don't incur bad credit, because then I'm sure our banking friends on here start telling you what your loan rates start to look like if you get bad debt and bad credit. But we can help you to save the amount of money that you need to start planning, because before you know it, 25 years ago go past, like some of us that are on this call when we were back in college, and you're like, man, how much time has gone by? It happens pretty quickly. And the earlier that you start, the better off that you'll be.
Thank you, Rodney. Appreciate that. All right, next question, Jonathan. This is going to come for you. All right, how can a person independently invest in stock, kind of without a broker?
Here we go. So how do you invest? So I can't tell you every way to do it, but I can explain how I do it. I think I started this journey probably about 8 years ago. I signed on to an account for TD Ameritrade. And the way that I did it, I started small. I had to determine what type of investor I wanted to be, how much money I was willing to lose, how much risk I was willing to take. There are several platforms. You don't have to use the same platform. I talk to people all the time, John Maiden. I know Dre likes to try to get into stocks. I know that several people, I got friends that I reach out to every single day that use different platforms and tools. I use TD Ameritrade. You can use Fidelity. You can do Charles Shaw. You can use E-Trade. There are several tools that you can use, and all those tools have different levels of information. You can get news. They give you tools that you can actually play with fake money. But what I suggest do is find out what type of investor you want to be. Find out how much money you're willing to spend. Start out small. Don't go big. Find a stock that you're interested in, something that you'll pay attention to. For example, if you watch Netflix, why not get a share of Netflix? Netflix is about $320, $340 a share right now. That's expensive, but if you watch that one stock and you see how it grows and see how it changes, you'll start paying attention to the news articles. You'll start paying attention to the subscriptions that people have. You'll start paying attention to what type of movies they put on there. Will people be interested in it? And what happens is you become interested in what you're invested in. So when I think about what I want to put my money into, I say, what is something that I won't have a problem paying attention to? Like, you don't want to make it difficult for yourself. You want to pick something that you don't have any interest in. You stop looking at the stock and you put $300 in. Now that $3 is $3. And let me tell you, it can go from $300 to $3 in a very, very quickly. So that's the most important part is find out where to start. There are several places on the website. You can go to websites and just type in anything that you're interested in. How do I become a stock? How do I invest in stocks online? What are the best platforms? What are tips for beginning stock investors? And what you want to do is understand exactly what it is that you are willing to lose. Because at the end of the day, it's your money. If you're willing to lose, $300. If you're willing to lose $10,000, you have to be willing to lose that, because at the end of the day, the stock market is a risk. You're taking a chance on yourself and on your ability to make your own decisions. And that's why they have people who are professionals like Rodney and any other financial advisor and investors that actually they're paid to have algorithms to invest your money for you. They charge you a fee for it, but you don't have to worry about watching it because you pay them to watch it for you. But if you want to do it yourself, the most important part is you can't stop paying attention. You got to do it daily. You got to do it regularly. You can't put it down and say, I'm not going to look at it for a month and then come back and be surprised that, your funds are different than they were the last time you looked. So I think that's the basic place I would start.
All right, thank you. Appreciate that. Good information right there. Next, I'm coming to you, Eric. Why, as a realtor, why is it important what is the importance of home ownership, and how can home ownership benefit an individual and their family? You mentioned something about wealth and creating wealth or building wealth earlier. Go ahead.
Right. So that's one of the main things that you're going to get out of home ownership is simply the wealth. People look at home ownership as a place to stay, but in addition to that, it's an investment. And it's one of the, if you look over history, it's a pretty profitable investment. The real estate industry is definitely taking some significant hits, but it's always bounced back. So that's the main thing that you're going to get out of home ownership is building wealth. And that's something that takes place over time. The longer you live there, the more wealth you're going to be able to obtain from that ownership. In addition to that, this peace of mind of having a place to stay and not having any concern as to whether or not somebody is going to discontinue your lease or not renew your lease, and you having to find another place to stay. Along with that, it tends to give a sense of pride in having ownership and from year to year being able to put sweat equity into that and continue to develop and improve the worth of your property. And then just outside of that, some other things that, as far as for home ownership, I guess tax write-offs, those are an additional benefit that's kind of outside of my realm. So the brothers that's in the financial sector can maybe speak to that a little bit more, but those are some of the main things that I would say as far as home ownership that are important.
Thank you, Eric. Appreciate it. And appreciate your insight. Okay, Jay, here's a question for you. For those that are interested in starting their own business, what do they need to do, and what are like some potential roadblocks in beginning or starting your own business?
So I would say, first off, know what it is that you're looking to accomplish, right? So what type of business is it? Do you need specific licenses? Do you have to be registered with your state, with your county? If so, if you don't know where to start, there's numerous programs and opportunities out there. So as an example, there's a minority business center that can assist most business owners with just starting that process. So starting a business plan, helping you to get registered. So I live in the state of Ohio, helping you to get registered with the state of Ohio. And so if you're going to need capital, how much money do I actually need to save to inject into my business? Am I going to have to borrow any money? What type of credit score will I need in order to borrow money? How many years I need to be in business before I'm able to borrow a specific amount of money? So most times what I see is when individuals look to start a business, they don't know where to start, right? So how much money do I need? So we got Rodney who owns multiple businesses. To start a nightclub, I mean, he has to inject thousands of dollars personally into that nightclub. What type of insurances will he need for that nightclub? If you want to start a small janitorial business, you may have to be registered with the state of Ohio, but that's probably it. You are going to need some insurances. But I say, first off, if you don't know specifically what you need, go to your bank. Your bank can help you to get registered if you need to, help you with getting a tax ID number with the IRS, with the US Treasury, and establish a relationship with your bank. Let your banker know what it is that you want to accomplish, how long you want to be in this business. What does this business look like for you? So I would say, first off, start with your bank. Look for any different opportunities within your city. Again, minority business center can help you. Your local chamber can assist you with those processes. They can help you to network. Stay networking if you're a business owner. I mean, if you're in it to make money, you got to meet different people who are in the same industry that you're trying to get into, because those connections will ultimately help you to succeed. So first off, know your numbers, know what you need, and get in contact with the right individuals to help you succeed, is what I would say.
All right, thank you, Jay, appreciate it. Rodney, coming back to you, we got a question out there. Could you kind of explain whole life versus whole term versus
Term life
versus term, whole life versus term insurance?
Okay, and it's a great question. They're both good for their purposes. Term life is exactly for that. It's for a certain term. So if you have a 20-year term policy, the policy is good for 20 years. So let's just say you take out a $100,000 term life policy for 20 years and you're 21 years old. That policy will last you until 41, if in fact nothing happens to you within those years. So then if something happens to you, God forbid, in those years that policy is in effect, then whoever your beneficiary will get that money. If nothing happens to you in that time period, then that policy will then end at the end of the 20 years. The difference is, in a whole life policy, whole life, you accumulate what's called cash value in that policy, where it accumulates over the time, and you'll have a certain amount of time. So let's just say it's a 15-year, 20-year whole life policy. You'll pay into that policy over that time. And then at the end of those 20 years, that policy will still stay in effect, and that cash will continue to compound and continue to grow. The big difference in why a lot of people have term policies versus whole life policies is that term policies are cheaper. You can get more coverage with a term policy than you can with a whole life policy. So you'll see people with $1 million whole life policy, and they're not paying that much money, but at the end of that term, anything that you've paid into that policy goes away. Whereas a whole life policy, you pay into that over whatever the specified term is, and then the money will continue to grow. And you can use that cash value for whatever your choice. You can use it as an investment vehicle. You can use it just for burial expenses. You can use it for legacy building, whatever you want to do. And I can just tell you, me personally, and what I recommend is that you can use both. So I have a term policy and I have a whole life policy. My whole life policy continues to build cash value every year and continues to compound. The company that I'm with, Northwestern Mutual, pays dividends. So that dividend is paid back every year into that policy, and that continues to compound. So that's really the two bigger differences with whole life and term. But I definitely would recommend, depending on your age and where you're at, the younger you are, the cheaper a policy is going to be, either one that you choose. So if you're trying to get a policy at 50 years old, it's definitely going to be much more expensive than if you're 21 years old. If, again, as I mentioned in my opening, if I knew some of the things that I know today, I would have done some things differently. So if I had an extra $100 to invest, I'd be putting it into a term or into a whole life policy and allowing that to continue to grow.
All right, thank you. Good. I mean, that's great. So next question for you, Jonathan. we talked earlier, before everyone jumped on to the call, we talked earlier about cryptocurrency. Could you kind of explain what cryptocurrency is? Like someone asked, like, is it legit? Is it safe? And so forth. Could you kind of go over that for us?
I would, yes. And I'm not the expert in cryptocurrency, but I do know a little bit about it. Cryptocurrency is an electronic currency. It's managed online digitally. The challenge with the cryptocurrency is, in order for you to actually gain real value from it, somebody's got to pay you more for the cryptocurrency than you pay for it. So if you paid, $1 in cryptocurrency, somebody needs to pay you $2 for you to deal value from it. If nobody lives in that environment where you exchange cryptocurrency, then you don't have any value for it. So it's only as valuable as the people who live in that environment that trade with cryptocurrency. It's very, from my understanding and what I know about it, it's very volatile. It changes price daily, hourly, actually by the moment. And the reason that it's not mainstream or the government hasn't put regulations on it because they had no way of controlling it at the moment. It had a lot of legs right around 2013, 2014. A lot of people were very big into it. You can make, the amount of money and increase in value that it changed over a short period of time was quite impressive. And I was actually disappointed that I didn't take advantage of it at the time. But now it seems to have lost its luster. And I think Arnett kind of mentioned it a lot earlier. People don't think that is real. I think they're kind of nervous and skeptical, as they should be, because anything that you can lose your value in that you have little control over managing, you probably should be aware of and be leery of what you're putting your cash into. But if you're more interested in cryptocurrency, I would recommend going online. That's what I do. Anytime that I have interest in anything, I go online and look for it. And then I find somebody, a specialist, and someone who actually studies on it, or I find somebody personally that I know that may know more about it. So that'd be my recommendation on cryptocurrency.
All right, thank you. And this is just, I'm putting this out there for all my experts. How should parents teach their children or tell their children, explain to them about financial responsibility? How do we as parents do that for our children?
I could take this one. So for me, I got little boys. So one is getting ready to turn 5 next month. Another is 3, and another is 1. So they're not understanding too much about money, right? But I think it starts today, teaching them the value of money. My 5-year-old understands if we go out to the store, if he ain't got his money, he can't buy nothing. So now he has chores at 5 years old. He can't do much, right? But he's taking his little trash out. He's helping me with trash in the house. So he's learning and understanding, hey, I have to earn money in order to spend money. If I want chewing gum, the only way I'm going to buy that chewing gum is by earning it. And I say it starts with those small principles at an early age, helping them to value money. So if I don't have the money, I can't spend it, right? Do I really need this or do I want this? So for me, with me being a financial professional, I thought it was important starting them off early. Even if they don't understand, we teach them so many other things. Why not teach them the value of money, the importance of money, the importance of saving your money, the importance of accumulating wealth. We haven't gotten into actually accumulating wealth, but right now, let's save your money to where you want to spend your money, so that when you want to spend that money, you have it put to the side. So we have a little bucket that we keep in our kitchen. There's only a couple of dollars in there. They're not getting rich, but if they see coins come in the house, they got a piggy bank. They put the money in the piggy bank. If they earn that money, they're putting that money in their little bucket in the kitchen. So I say it starts at a very early age. Get them accustomed to it early, teach them the value of money and the importance of it and how valuable it is. So
I'll just follow up with what Jay said, is that the other principle that I believe strongly in is just saving. And how much do we save and how much can we save? The younger that we start saving, the better off it is. Because as I mentioned, when you get to your 40s and your 50s, it's a lot tougher to start creating new habits at 40 and 50 years old than when you are in your 20s. And it's very tough for all of us. We're all tempted to want to have that new car, or to have the very best of everything, or the new purse, the new shoes, and we have to create budgets. So budgeting is critical. Saving is right there. So those will be the other two pieces that I throw out there: is creating yourself a budget. How much do you have to be able to spend on yourself after every paycheck? How much do you need to save out of every paycheck? Your savings needs to come out first, so that then you can then focus on other things that you need to do. But once you set your budget up, set your savings plan up, and then set your overall strategy up long term, I think you'll be in better shape.
Thank you.
And I will say there is a little nugget. So I do financial literacy for youth. And so for any parents that are looking to teach their children, there is actually classes that you could help your children with, to teach them with. You go directly to the FDIC website, and depending on the age of your child, first grade, second grade, a senior in high school, there's actually a financial plan that you could kind of teach your child. Again, just the value of money, saving money, what credit is, how to invest, so the same things we're doing now. You could actually go to the FDIC website, and there's courses to help you teach your child what it is to have money, how to utilize money, credit, and things of those nature. So I would challenge any parent that may not feel equipped enough to kind of have those financial conversations. Use a tool that's already out there that's proven successful to help your child along the way. So
I would like to add to what Rodney and Jay said. You know, I think introducing it to your children as soon as possible. You don't want to put the pressure on them. You don't want to be stressed out about money and funds, but I think you should introduce what a budget is. Introducing the value of money. You know, when you go out, let them take their money with them, but let them know, like, you can't spend it all this time, and you tell them why they can't spend it. A good tool that I use and me and my girls play is we play Monopoly. You know, and I think it kind of touches on a lot of the stuff that we talk about now. You know, everybody starts out with the same amount of money, but if you own a block, you own a house, guess what? You control all the resources in that block. And now every time somebody lands on your property, now you have to pay them. And that's how you recur. That's how you get residual income, right? Because every time you have a place or a resource that you own and people have to pay you for it, that's money in the bank. You know, one area that's very important is stocks for me, right? So I like to play in stocks. You know, my kids love to go to Justice and they like to shop at Justice. No, so if they're interested in Justice, when I give them their allowance, I open up a stock account for them, and they have to invest in something they're interested in, like Justice. So we do a send up retail company stock market, and you know, $5, $10 here, they can add it up, and by the time they're 15 or 20 years old, they have something that's worth looking at. The thing is, when you take your own resources and you invest it, like when it's your money, you treat it differently. And I think the sooner the kids know that it's theirs that they lose and not their parents that they lose or somebody else's that they lose, they treat it much differently and they have more respect and more value for it.
Eric, do you want to add something to
that? Really almost to piggyback off what he just said, almost at an early age, thinking more so about planting the seed of the possibility of home ownership. I feel like that's something that we kind of come to the realization or we see that as a possibility later in life. And that's something that we can change the concept of that with the younger generation, maybe through a game like Monopoly, just maybe putting the idea in their mind that they too can be a homeowner, and renting is not necessarily the first step. You know, there's plenty of people that come out of high school, come out of college and go straight into home ownership. And that's something that I would like to maybe see in the younger generation, us being able to plant those seeds and creating a path for them to obtain that.
All right, thank you. Thank you, gentlemen, for everything. Eric, this next question is going to be for you. Could you discuss the importance of a credit score when buying a house?
Yeah. So a credit score, the main effect that it has on you as a home buyer is it is going to affect your interest rate. And basically that translates to how much buying power do you have. Essentially, like right now, the average sales price here in the Louisville area is $225,000 to purchase a home. If my interest rate is at 3%, because I have a higher credit score, I'm going to be able to purchase their home and maybe, I'm just throwing a rough average out there, maybe have a mortgage of about $1,500 versus someone who has a credit score that's maybe 1% higher. They maybe are looking at $200 or $300 more per month in that mortgage payment. So that's one of the things that we look at. I do not have, as a realtor, that's not something that I see as far as your credit score. But it's definitely something that I would consult with you on as far as getting you in touch with a lender or a banker that you can take a snapshot of your credit and create a plan. Sometimes, buying a home, sometimes it's not something when you sit down with me, it's not something you're going to do immediately. Sometimes it's maybe we're going to wait 6 months because you have created a plan with your banker to improve your financial situation, so you have a better credit score and you can buy more home for essentially less per month based on your credit score.
All right, thank you. Jay, I'm gonna stick with the same question kind of towards you. So what is the importance of a credit score when trying to buying commercial property if I'm going to be a business owner?
Yeah, so depending on the size of the business, you may not even need to utilize your personal credit or have a personal guarantor. So depending on the situation, depending on the size of the business, the strength of the business, you may not have to be a personal guarantor. Now, we as a bank, we may look to see the strength of the business owner, how much, we'll look at what we call a personal financial statement. How much cash does this business owner have versus their credit score? Now, if you're a smaller business, you're just starting out, 2 to 3 years in, you haven't been in business that long, and we're looking at the strength of the borrower or the strength of the business owner, your credit score is very important at that time. We look to see when's the last time you've been delinquent. So let me back up. So the credit score is not always the most crucial thing. We look to see what's on the credit. What types of different credits do you have? Do you have a car loan? Do you have credit cards? Do you already have a personal mortgage? And how are you paying those different credit items? How much credit is extended to you? And what are your monthly payments compared to your income? Now, in terms of the credit score, we do look at your credit score. Depending on the size of the project, the minimum credit score may be 660. And Eric kind of mentioned it, getting with a bank to create a plan, right? So if I have a 620, but I need a 660, and all I got is one credit card, how do I take those steps in order to get a 660, 680, 700? Obviously, the higher the credit score, the better terms you're going to have, the better rate you're going to have, the less money you have to inject into that purchase. So first, I say get with the banker, or have a financial expert on your side to kind of have those discussions about your individual credit, what's on your credit, the strength of your credit. Because again, it's not always about the credit score. You can have a 670, 680, but only have one credit card. The bank can't tell, is this a good borrower? Is this person going to pay me back? So it is important not only to have a good credit score, but also to have a variety of credit. So I would say, don't be hung up so much on the credit score. Look to see what's on the credit and have a variety of different credit items. So again, those credit cards, term loans, your automobile, your mortgage payment. Make sure you have a variety of credit when you're looking to borrow, especially for something like a commercial property.
Thank you. I don't know, maybe this question is for Rodney or anyone out there. Rodney, earlier you mentioned something about savings. You said put your savings away first. So what's a percentage of, say, a person's income should they put away in savings?
Okay, great question. There are 4 buckets that when you're saving that you want to put your money in. One is to start with a emergency fund, to have at least a 6-month emergency fund. And how you determine that is based on what your monthly expenses are. So when you take a look at cell phone bill, light bill, water bill, all your bills together and add them all up, car note, gas, eating, whatever you do, you add that up and you say, okay, my monthly amount is $5,000 is what I have to cover just to cover expenses and everything that I do. And then just taking that times 6. So say $30,000 is my emergency fund. Now you're not just going to come to your emergency fund right away. It's something that you're going to build to. But that's one of the first buckets. Second bucket is then to start looking at different things like mutual funds and stocks and things like that. Third would be your life insurance, depending on if you have kids, a 529 plan, which is a college savings plan, which you can achieve through life insurance or through a 529 plan. A 529 plan is for state schools where if you do a whole life policy, start when your kids are young, by the time that they reach 20 years old, there can be several $100,000 in that account that can be used and applied toward school. So that's one as well. And then the last bucket would be your 401k or IRA. So when you take a look at all of those things together, you should look at a average of about 20% of your money should be in savings. So then you work for a company, they have a 401k plan. And the key thing is you want to look at what is the company match. So if the company is matching 5% or 6%, you want to make sure that you're putting that 6% in so that you can get that company match back of 6%. So if you're starting with 6%, now you're at 14 additional percent that you can start putting into some of these other buckets. Maybe you're putting $300 a month into your emergency fund. And you just start to add it up to get to at least a minimum of 20%. You can go greater. I was talking with a client just the other day, been with the same company for 19 years and started saving very early. Started putting 15% into her 401k plan. The company only matched up to 6, but she was putting 15%. Now at 40, she has over $400,000 in her 401k plan, not including the additional $200,000 that she has her pension from that same company. So now she has $600,000 in her very early 40s. Now, as you start to put the overall plan together, put in a whole life policy with that, and you start to run the numbers, she's going to be a multimillionaire by the time that she retires because of the way that the money compounds, which she's in a phenomenal place. And as a financial advisor, one of the things that I do is tell you if you have a gap when you're trying to retire. So if you're 40 years old and you're saying, hey, I want to retire by 60, I take a look at what you've done to date and then look at by 60, what will you need to be able to retire and cover your monthly expenses. The average person is going to live a long time. Average person is going to live into their 70s and 80s. So if you retire at 60 or 62 or 65, now you have to be able to say, okay, how am I going to live those additional cover those additional 15 to 18 years when I'm not going to a job making a salary every day, and Social Security is not going to cut it. So the earlier that you start with your saving and the more aggressive you can be in saving earlier, the better that it'll be once you reach age of where you want to retire. That number, you could want to retire at 50. Well, but the thing is when you get to 50, you have to have enough money saved up because you no longer have earnings coming in. If you're making $100,000 a year and you're stopping 10 years early, that's over $1 million in potential earnings that you're giving up. And how are you going to continue to live? So that's what I would recommend is 20% at a very minimum.
All right, thank you. So question kind of for everybody. on the panel. All right. What is touch on like one topic that you think is valuable to the audience that you have right now? One topic that you think is very valuable.
I'll go. I think one topic is very similar to what Rodney said. Budgeting. You know, typically everybody knows what's in their bank account. They know the dollar amount in the bank account, but do you actually know what your transactions are in your bank account? I think it's very important to at least once a year, if not once a year, maybe once every 3 months, go to your bank and download all your transactions. Take a look at what you're actually spending your money on, because we have these cards now in our pocket and we swipe the machine so often, you don't actually know what's coming out of your pockets. You go online and you go on Instagram and you sign up for a subscription and you don't realize that it doesn't cancel, it automatically renews continuously and you're paying for something that you don't even use. You know, you go to a store and you don't realize a fee is coming through and it's a recurring fee and you're not stopping it, and the bank continues to take the money out of your account. Now, I think knowing what actually makes up your expenses, transaction by transaction, because what you could do is you can go through those transactions, you can strike some things out, you can find a little extra money that you can actually save or find other things to do with. I think that is critical to know exactly where your money is going. You know, you work entirely too hard to waste money. You know, think about the amount of, if you look at your transactions, see how much money you spend on clothes, how much money you spend on alcohol, how much money you spend on going out, how much money you spend on dates or restaurants or entertainment. If you don't know how much you're spending, then that's a problem. If you don't create a budget around those things, and hey, my budget is to spend $50 per month on going out or eating fast food. If you don't put a budget on it, guess what? You'll eat fast food 5 days in a row and your budget is already gone and you won't even know it. So actually know what you're spending and create a budget around everything. Your banks allow you to open up multiple accounts. And if you have enough balance in your account, they usually allow you to open up for free. Make yourself multiple accounts. Give those accounts different targets. You know, when you say, I want to go on a vacation, open up an account just for your vacation money. Have your money go directly from your bank, from your check directly into that bucket. That way you don't touch it. And when it's time for the vacation, you can take that trip and the money's already there. Same thing to do for a car, same thing to do for a house, same thing to do for any target that you want. But you can't do that if you don't know what expenses are actually coming out of your bank account. I guarantee if every single person downloads their bank account for the last 6 months right now, categorize it into 15 different buckets. Every single transaction can only go into 15 different buckets. It has to fit into one. What that does is allows you to pivot or consolidate it into 15 different buckets. You can see where all your money is going. Once you find out where all your money is going, you can evaluate where you're spending and where you're spending poorly. When you determine where you're spending poorly, you can figure out where you can get cost out. So that's the simplest way to budget. And that's what I do daily on a daily basis for the business, the company that I work for, right? I got to find out how to get cost out. Where's my purchase services going? Are my sales guys spending too much time at the hotel? Are they using too many, are they spending too much gas? Are they spending too much, are they paying food for too many of their customers and too many of their vendors? You treat yourself the exact same way. Treat your expenses the exact same way. Look at yourself as a company. Look at your balance, thinking your net worth as your asset. The way to determine the value of a company is its balance sheet, is value, right? It's net worth. Your net worth is based on the assets and the value of those assets, less the liabilities that you have. If you have more liabilities than your assets, then you need to stop spending. And you need to find a way to how to get there quicker than later. And you can actually do this right now. But the most important thing I would say when it comes to that is discipline, patience, and you have to have self-control consistently. You have to do that consistently. You can't say I'm gonna start a budget today and then 2 weeks from now, I'm like, you know what, screw it, I'm gonna go kick it and hang out. And guess what? You start it all over from scratch again. I think if you talk about this, not with yourself, but also with your family, because if you have a family and they're spending your money too, it doesn't matter if they're spending money and you're saving. If you're saving to your family, your wife, your kids are still spending money the same way, you're not regulating them. Oh, I wouldn't say regulating, this may be a bad term, but mention it to them, make it a consciousness to them so they understand that, hey, this money, we have a target as a family that we're trying to achieve. We want to go on a vacation. We want to go to Disney World. You know, we want to go on a trip to see grandma and grandpa, whatever it may be. Let everybody know that we have a goal as a group. And when you understand exactly what makes up your expenses and exactly how to manage it and how to create a budget, you'll be much more successful. And what you can find yourself doing is find enough resources to talk to somebody like a Rodney or like a Jay or like an Eric. Hey, I want to invest in real estate. Hey, I want to give my money to a financial advisor. Hey, I want to open up a bank, open up my own corporation, my company, because I have resources and I can do it and I set a target and achieved it.
Standing.
You know, what I'd say is, don't be afraid to go to your bank. So I work for a bank, so I'm going to say go to your bank. Establish a relationship with a banker, whether you're a business owner or just a person looking to save some money. Establish a relationship with a banker. Main reason being, just what John is saying, they'll help you create a budget. They'll help you talk about where your gaps are, where you're struggling, and to help you achieve those goals. So I know, especially for in our community, we're afraid to go to the bank because of what the bank is going to say. If we don't know where we're at, if we don't know how to achieve a goal, we're never going to get there. So just like you go see your doctor once a year, twice a year, I mean, finances are important. If it's not as important as your health, just what Rodney has said, once you retire, if you don't have enough money to kind of help support your retirement, I mean, how are you going to survive? So I think finances are very important. So go establish a relationship with your banker and make it routine. If it's not once a year, if it's not twice a year, at least once a year, and create a plan. And whatever that plan is, stick to that plan. And as things adjust accordingly. But make sure that you're achieving whatever goal that you've set out, whether it's saving for your child's college expenses, whether it's saving for retirement, whether it's saving for that first home. Make sure that you stay on track, and if things start to change, make sure you adjust accordingly. But try to stay to that plan that you and your banker or your relationship manager have established. So build a relationship, please.
Eric or Rodney, anything you want to add? Like,
Let Eric go, and then I'll close out then.
Mine is basically along the lines of what they've said. I would say you definitely want to plan and stay involved with your real estate ventures. Look at them as an investment. Continue to assess them on if not a yearly basis, at least every other year. If you have a home and you've utilized the services of a realtor, we don't only want you to work with us when you're buying and selling. I meet with all of my clients once a year, and we go over the value of their property, just so they can get an idea of what their property is worth, how much equity they have in their home, and how they can leverage that equity. There's different things that you can do as far as, I don't know, if you need to borrow against your home. And those are things that you can plan for, especially if you have children that are going to college and things later on in life. I know Rodney talked about retirement. How does your real estate ventures tie into your retirement plan? Do you have any options to be able to expand your real estate portfolio based off the equity that you have in your home? And those are things that we can sit down and evaluate yearly or however often that you can meet with your realtor. In addition to meeting with your banker and your financial advisor, those are things that you want to just continue to stay involved with, stay on top of.
Yeah, and I guess I would say Jonathan spoke to a lot of the pieces that I speak to as a financial advisor, and that's about discipline and self-control and patience and all of those things. But what I would say is, what legacy do you want to leave for you and your family? And no matter what age, is really, you got to start thinking about the legacy. And at some point, as I opened up, I talked about in 1950, the average Black family had $0 of wealth, zero. And that's just astonishing to me. Then we're still only at $13,000 of average Black family wealth in America. And it will take us at where we're at today to be able to make some decisions about the legacy that we want for our family. When you think about it, we all have parents, we have grandparents, we have great-grandparents. But I don't know my great-grandparents. I don't know any information about my great-grandparents. I can't tell you their names. I can probably go to my parents and find out their names, but I don't know their names. And the interesting fact about that is that what is the legacy that they left for me and my children. So here I am today, now having to start to create a legacy that's long lasting. And in creating that legacy, I have to make some decisions about what I do from this point going forward. And it starts with the budgeting that we've talked about on this call. This is uncomfortable. I meet with people, and this is a very uncomfortable conversation for them, because now you're starting to talk about money and how I'm spending money and my sometimes lack of, and it's a very uncomfortable conversation. But I think it's just time for us all to get uncomfortable so that we can make comfort for ourselves later and for our children. So when you look at the question of about a whole life policy, you can leave millions of dollars as a legacy from a whole life policy. And there's so many things that I can talk about, and we don't have the time today. I would definitely welcome the conversation. And for those of you who know me, I would tell you, don't be ashamed or uncomfortable with having the conversation, because I'm here to help you. I'm not here to judge you.
Right.
I'm here to try to help you and your family, your children. Like, do you have a will? Do you have a trust? What are some of the tax implications of some of the decisions that you've made? What are those types of things? And if you're starting from scratch, and then let's say you're 45 years old and you don't have a dime saved up for retirement, I'm here to help you try to put a plan together. And don't think about it as a person judging you, but you have to be the one who makes a decision that I got to start today to be able to make that happen. So I'm available for anybody who wants my advice.
Hey, thank you. Hey, John, before we get off here, Jonathan, there's a question for you. You mentioned investing in like Netflix or any type of stock. So is that something that is it a recurring fee that happens monthly or yearly, or is that a one-time fee that you would pay?
Most sites, most tools are free for transactions. That they've done that. I remember when I originally joined TD Ameritrade, they charged like $9 a trade. But because of sites like Robinhood that trade for free, they've eliminated those charges. They've had other ways of making money. There's also a bank, right? So they have transaction fees, right? They charge you for options. They'll charge you to loan you money. For example, and get back to Netflix, right? You buy a share of Netflix. You buy one share of Netflix. That's one stock, whatever the value of it is at the purchase price. If you want more share, you want more value in the company, you can buy more shares. Now you can buy 10, you can buy 15, you can buy thousands of shares of stock. It's just at your description. It's really how many funds and resources that you have at your disposal. But those usually the basic trading systems, they don't have any fees for transactions. They'll find other ways to charge you. But for the normal everyday transaction, if you're going to do less than 10 transactions a month or 10 transactions in a day, I haven't seen any fees come my way. When you talk about, maybe when you get into options like shorts, when you talk about puts and takes, they like to try, like for example, TD Ameritrade charges you 68 cents per option. So if you decide to go option charging, they'll do that. One thing that I do now is I do margins. I have a margin account. What a margin account is, and I use hypothetical numbers. So say that you have $20,000 available and you have it in your TD Ameritrade account or E-Trade or whatever, your Charles Schwab, whatever account. What a margin is, the bank essentially loans you money. They loan you typically about half, a little bit less than half of the value of your actual cash. And so if you have 20, they'll loan you about 10. And that 10 is there for you to buy additional stocks. Now, if you make money from those stocks, that money is yours, but you just have to give them their money back. If you lose on those stocks, you still lose your money and you got to give their money back. So you can lose your pocket quite fast if you do it the wrong way. So day trading is a very, people talk about day trading. It is something that you can do, and it's something that I'm actually in the process of doing now. So I follow stocks daily, day in, day out, and that means I trade stocks continuously throughout the morning. I usually do it from 9 to about 12. I usually follow a site and I go to Trader TV Live and I watch them and I look up articles and I use my Seeking Alpha app and I use my Zacks app and I use my Stock Spy app and I look and I read articles on stocks that I'm interested in. And so you need also a network of people also. So I have a network of people that I exchange text messages with and I exchange emails with, and we exchange what stocks are hot right now because there are over 600,000 stocks out there in the world today. So you're not going to be able to follow all of them, but you need somebody to give you a tip. And for example, I reach out to some of my fraternity brothers, some of my business guys, and they say, hey, you got to follow this stock. And they'll wake up early in the morning because they know you got to get it, some of these stocks you got to get early because they move a lot more in the morning than they do in the afternoon because people are day trading and day trading changes the value of the stock. So, transaction fees, they're using our transaction fees for daily transactions, but they do have service fees for those different unique type of transactions out there. Hopefully that answered the question.
All right, yeah, yes, it does. Thank you. Appreciate everyone coming on here. Jonathan, Jay, Rodney, Eric, appreciate everything that you all did and everything that you all gave, everything that you all provided. Rodney, I think was really big, as you saying that legacy, creating a legacy, having something to pass on to future generations. So passing on generational wealth as opposed to passing on generational poverty. And thank you all and everyone for coming and attending. And this is something we may want to continue. I think Rodney left his number in the chat if you all would like to get with him about as a financial analyst and advisor. He left his number and his email. Well, what is that, your email?
Yeah, that's my number and my email.
Okay. Most of these guys are on some type of social media. If you all want to get with them or forward some information to them through their social media or any other way, or through this chat or any other means that you like. But thank you all for coming, and that concludes kind of the meeting. Dre, would you like to add something before we go?
No, I really actually learned a lot from this. So definitely going to share this with some people that didn't get to attend, but appreciate you guys. Some good takeaways there, and definitely something I learned. I'll probably even go back and watch it again myself just because I know I missed a couple things. I did have one quick question for Rodney, if you wouldn't mind, before we hopped off though. In terms of like working with a financial advisor, is there like a minimum investment amount, or like is it anything that any restrictions on working with you versus doing it on our own? Like, is there a threshold at some point?
So there's actually no cost to work with me. I actually get paid by the company that I work for, the insurance company. So in helping you to set up budgets and set up a plan, there's no cost for me doing that. Is what I do every day. I would recommend that for anybody who's looking at a financial advisor, just the word financial advisor is a little convoluted, where there are people who want to see how much money you have, and then they want to invest it for you. And then there are financial advisors like me who are working with you to establish your budget, hold you accountable to it, have quarterly, once a year meetings, whatever it may be, with you. But there's no charge for the services. I get paid on the back end if there is a product that we do have to offer and recommend to you, and you wind up accepting that.
Okay. And do I need to, like, let's say, have $2,000 or $5,000 or $10,000 to work with you, or is it just whatever, come with what I got?
You come with what you got, and then I'll help you from there. And that's the beauty, and that's why I'm in this business, is be able to help individuals no matter where they're at. So you can have $1 million and still need help, or you can just be starting and need to know, how do I start putting my plan together? And that's what I'm here to do, is to be able to help create this generational wealth that we're talking about and help individuals to leave a legacy. So there's no cost. There are individuals who want to only work with high net worth individuals. But for me, at where I'm at in my life and my career, my job and my goal is to be able to help individuals to build and to grow and to be able to help leave a legacy for those who come by behind them. So when you become that great grandparent, they'll know your name.
Gotcha. Okay. And if Wes would mind, I see one other question that popped up in the chat that I would actually love to hear people's quick answer on. It says, what did either marriage or divorce teach you about money? Anybody want to take a shot at that?
I'll take
Keep
this
in
one.
mind, this is being recorded, so.
Yeah. So I think marriage is different. I think being a man and a Black man, managing resources, whoever the person in your house who manages the resources, it doesn't have to be the man. It's whoever the person who's best with cash and you trust with the cash. But I think it's very important that everybody understands the goal in the house. I think it's very important that everybody understands that, hey, we have finite resources and we need to do the best with what we can. I think if you make it a continuous effort with each other, with your partner, saying, hey, make sure, it's on the top of their mind, because, we can go on little sprees where, hey, every day of the week you start buying stuff and you don't realize that you're doing it. And you need somebody to help you hold yourself accountable. I think it's very important that you hold each other accountable, especially when you have a spouse and somebody who can, who's watching you. Because a lot of times we don't see ourselves until somebody shows ourselves to us, if that makes sense. So I think, if you have somebody who can help hold you accountable, help give you standards, help give you a goal, because what you can do is you can establish standards for you and your household, and you can have somebody else hold you accountable for those standards that you created together. And, those standards will help you achieve your goals together as well. So I think that's very critical to marriage in general, right? Setting goals and making sure that you achieve them together and holding each other accountable to make sure that you improve and achieve the things that you set for.
Divorce is one of the biggest robbers of wealth that's out there. And it's unfortunate. I've been married and divorced, and you think about it, you have 401ks, you have houses, you have all those different things that wind up having to be split up. And for whoever has, spousal support, child support, all those things that wind up interrupting. And it's an unfortunate thing, but it is a robber of wealth, and something that with the right plan and the right strategies you can survive from and come back from. But everything just requires planning. And I think if there's anything that we've talked about today is about a plan, whether you're buying a house, buying a business, buying a car, or saving money, it's a plan that you have to have, and start with that.
Yeah, appreciate you guys. That's all I got, Wes. We're gonna go ahead and bring it home.
Yeah, that's it. I think it's home. Like we touched on everything that was important about wealth and kind of building that wealth, about financial literacy, which was most important to this right here. Hopefully we can do a little bit more in the future. I know some brothers have talked about entrepreneurship and kind of starting a business. That is another way we might want to go in the future. But I think we got what we need and what we wanted out of here. If anyone wants to if anyone who missed it, who just popped on, some of you are just popping on, we're closing it out right now, but it is live on YouTube. Dre, leave it somewhere on YouTube. And thank you all. Thank you all.
It's on the Beta Mu Alpha's Alumni YouTube page.
Okay. All right, thank you all. Hey, and come back tomorrow. Tomorrow we're gonna have a Juneteenth celebration to honor, what should have been honored a long time ago. But we're gonna have that celebration tomorrow. Hopefully we get a few more people on there. And Dre, tell them more about that.
Yeah, so we got a couple DJs going for you guys. We have a amazing host, and I even hear rumors that, weather permitting, there's going to be a little fireworks display to commemorate the evening. So trying to do something nice, really just celebrate Juneteenth.
Weather's going to be great here, so.
So we're all set.
It's all set.
Cool. As we leave, I did want to, I'm going to just share my screen. Somebody's on the call just actually sent me this here. It was shared with them from a financial advisor that they actually gave to their students. So that way, this will be on the YouTube now, just like a budget for the kids. I'm not sure if anybody on the panel, any other advisor, do anything like this or have seen it before, but it looked like something definitely worth sharing. So at least wanted it on here for record.
Now, Dre, I've created a personal budgeting tool. It's in Excel, but if somebody's interested in using it, I can share that with everybody and they can populate it so they can at least get their mind wrapped around budgeting and what it means to follow transactions and see how they're spending.
Oh, awesome. And what's the best way for somebody to reach out to you for that? Facebook, Instagram, phone, email?
I don't, unfortunately, I don't have a Facebook page, but Instagram and cell phone or email, and I can post that information. And Dre, if you feel like posting the information on the site, I'm open to that as well.
Okay, cool. I'll put it in the notes for the YouTube page too.
Okay.
Cool. Wes?
Thank you all. Have a great evening. See you all tomorrow.
All right, now. Thanks. Have a good one.
Thanks, guys.
Thanks.
Thank you all.
All right, and we're done recording. We are all good. Wes already hopped off. Yeah.
Hey, Rodney, you still there?
Yeah, I'm still here.
Hey, Rodney, I'm gonna get your information, man. I'm gonna reach out to you. I like to connect and just kind of exchange thoughts.
Oh, shoot.
Jonathan, you got muted. You got to mute yourself.
My bad. I'm trying to unmute everybody and it muted everybody.
Yeah, I was saying, Rodney, I want to reach out to you. I'm gonna get your information. I think you got a lot of good stuff that I'm very interested in, and I'd like to maybe exchange ideas and thoughts. I got some things I'd like to pick your brain about as well, so I'll definitely be reaching out to you. What I'll do is I'll send you a text so you got my information as well.
All right, I look forward to it. Feel free, anybody, send me a text message. Like I said, I'm here to help. I'm not here to judge or anything. My goal is to help folks create generational wealth and leave a legacy. So let me help you.
A couple of people still in. If they had any questions, I'll leave it open. Otherwise, what's up, Cook?
Hey, what's that?
Go to the next panel, man.
Hey,
I did have a question, but
man.
Dre unmuted me like 8 hours too late.
Who is it for? We still got a couple people here.
No, Eric is gone. But I got a question for Rodney though. So I've got an IRA. You mentioned, having those 5 buckets, kind of your state, like your you said 5 years worth of saving or 6 months worth of saving, something like that. I've got an IRA as well. I generally put like $200 a month in it, and my financial advisor, who's a brother, actually, by the way, he mentioned I need to put more in that monthly if I want to, kind of see it grow exponentially. But like I can't afford to put too much more in there and still do what I want to do. Like, I'm very.
Hey, Arnett. I don't mean to interrupt you. Why don't we do this? Why don't you call me directly?
Okay, I will.
And then we can take a look at where you're at. I just don't want you going into too much financial information. Okay. The numbers on there. Feel free to reach out anyway, and we'll just put together some time and try to put your plan together. And the key thing about, or one of the good things about working with a financial advisor is being able to really customize it to individuals. So it's not just a size fits all. So I'm not going to give the same thing to Jonathan that I give to you. It's the same buckets, but Jonathan may be putting, 150 in, you may be putting 200 in. So it does vary. So definitely reach out to me and let's put a plan together.
No doubt. I appreciate that. Mm-hmm. This was good though, man. You guys, this is much needed. You guys dropped some great information. I really did.
Glad you enjoyed it.
Yeah.
I'll be honest. I'm open to doing it again. I love this type of topic. It's there's not enough time you can spend doing it, but especially when you get people in different sectors and specialized different things, that you can learn a lot of stuff in a short period of time.
Absolutely.
All right, guys. Well, thank you very much. I appreciate the opportunity.
Appreciate everybody.
Thank you.
Thanks, guys.
Wait, Cook said something. I have. Oh, okay. I don't necessarily know what the context of that. Good.
No, what it is just that I heard people talking about fees on checking accounts and business accounts, and so I run a bank office, and so I can make sure that nobody gets any fees if anybody's getting feed to death. And it don't matter where you live at in the United States. I can handle that. So that's what I was throwing that out there. I just hate to see people paying for charges. I don't like people to get charged for services when it can be free. And a lot of Black people don't realize what actually is free, and so they get nickel and dime. And so whether it be overdraft fees and stuff like that, so I'm a huge proponent on that. But if anybody ever needs any information, I just want to put my number out there. We service in all 50 states. So
Yeah, now if you open to it, I can definitely add that information on like the YouTube details where I put all the other stuff. Is it cool to put your phone number, or is email better? Or
yeah, that's fine. I can and I can shoot you my business card as well offline through through Facebook Messenger or something if you need it. So
okay, cool. No, I definitely appreciate that.
No problem.
Cool. Ladies, gentlemen, it was real. Appreciate your time. See y'all tomorrow and on Tuesday.
All right.
Thanks, guys.
Thanks, everybody.
Peace.
See ya.